One of the longest term dividend kings, Procter & Gamble, is down by 7% over the past month. And let me just put that into perspective. PG has been paying out a dividend since 1957, so they have a dividend growth streak of 68 years, which is longer than Pepsi's of 52 years and even Coca-Cola's of 62 years. If I move to the dividend growth tab, the company has an A+ on its dividend growth, making it a great one for dividend growth investors. So with Procter & Gamble announcing their earnings on the 22nd of January, should you add this dividend darling to your portfolio? And to figure this out, as always, I will jump to my stock valuation spreadsheet, where I will plug in the ticker PG and wait for all the metrics to show up. Now first, let's direct our attention to the dividends. PG currently has a dividend yield of 2.52% with a trailing free cash flow payout ratio of almost 60%. Now the reason why I don't mind the payout ratio sitting this high is because Procter & Gamble is a very well established company that cannot really push much of their free cash flow into innovation. Actually, if we jump to pillar 8 and look at their free cash flow payout ratio over the past 5 years, we can see that the values are very similar to each other, and that is actually the case for the past 10 and even for the past 20 years. So for them, the 40% of their free cash flow they have left after paying out their dividend is well enough to buy back shares, pay down debt, invest back into the business and increase their dividend. But now let's jump to the 9-pillar analysis and have a closer look at Procter & Gamble. We can see that the company gets a rating of 7 out of 9 with 2 pillars currently in the red. Now as always, let's first have a look at the growth of the company, which I don't expect to be too high. You can see that the 5-year revenue CAGR is sitting at 3.44%, the 5-year free cash flow CAGR is sitting at 4.32%, and the 5-year net income CAGR is sitting at only 2%. Now if I zoom on to these pillars, you can see that the profits have been growing very slowly, but they have also been growing very steadily. Now maybe you're thinking, why would I invest into a company that has such low growth? Well, what you have to understand is that many investors are actually willing to invest into companies with low but predictable growth. If I jump back to the stock screener, we can have a look at the beta of the company sitting at only 0.46, which means that Procter & Gamble is twice less volatile than the overall market. So if the market moves down by 5%, Procter & Gamble will fall by only 2.5%. Now what you also have to consider is that a company's stock price growth is very much based on its profits growth. So if Procter & Gamble has been growing on average at a rate of 3.5%, if you invest into the company, your investment will grow at a rate of about 3.5%. So you're essentially trading high growth potential for low risk, which is the tactic of many investors. Now let's also figure out if Procter & Gamble has been trading fairly valued over the past 5 years. We can have a look at their 5-year PE ratio and their 5-year price to free cash flow. If I zoom on to pillar 1, we can see that the PE ratio has actually been rising over the past 5 years, and currently it is sitting at 27.53, which is higher than the 5-year average, and means that investors are paying $27.50 for every single dollar of the company's earnings, which is more than what they would pay for the earnings of an average company. Now you might argue that Procter & Gamble should be trading at a premium, but I personally wouldn't be willing to pay such a big premium for a low growth company like Procter & Gamble. Now let's also have a look at their free cash flow. So looking at their price to free cash flow, we can see that currently it is sitting at 23.90, which is higher than the 5-year average and higher than what investors are willing to pay for an average company. So overall, Procter & Gamble does look a little overvalued compared to the earnings they generate and compared to the free cash flow they generate. Now, one thing I do love about the company is that they have decreasing shares outstanding at a rate of 1.21%, and this means that yearly they can pay out less of their free cash flow in dividends and therefore have more free cash flow to increase that dividend. We can see that the 5-year dividend growth CAGR for PG is sitting at 5.19, so they have been increasing their dividends very nicely and very steadily over the past 5 years. If we again jump to pillar 8 and scroll a little up, you can see that their year-over-year dividend growth is higher than the average stock year-over-year dividend growth. And when you combine that with their above average dividend yield of 2.52%, you get a company that is great for dividend investors that are trying to achieve the dividend snowball effect. Now, before we move to calculating the intrinsic value of Procter & Gamble, I want to point out 2 more things, and that is the low debt of the company and their high 5-year profit margin. If I zoom into pillar 6, we can see that the profit margin has been very stable over the past 5 years, currently sitting at 16.72%, which is well above the sector average. And regarding the debt of the company, their long-term liabilities over the 5-year free cash flow negative dividends ratio is sitting at only 0.51, which means that with the free cash flow they currently generate and with the dividends they currently pay out, it would take them only about 2.5 years to pay off all their long-term liabilities, which is great. Now, before we get to calculating the intrinsic value, if you enjoy these valuation spreadsheets and find them helpful, make sure to download them at the link in the description. Now, first let's move to the grams formula revised. And here I will plug in the high earnings per share growth estimate at 6%, medium at 4%, and low at 1%. And combining this with the analyst predictions, we will get the 5-year earnings growth estimate of 5.26% into the future. Now, when I combine this with all the other values, we will get an intrinsic value of only $78.11, which is more than 100% lower than the current trading price. But we still have 3 more valuation models to go through. So jumping to the discounted cash flow model, we will plug in the free cash flow over the past 5 years and calculate the future growth rate of 4.3% using the same method as before. Now, using this calculated growth rate, I will calculate the future free cash flow, and then plugging in a discount rate at 7.8%, I will calculate the present value of that future free cash flow. I will then sum all of it up, add cash and cash equivalents, and subtract total debt to get an equity value, which I divide by the shares outstanding and get an intrinsic value of $155.25, which is slightly lower than the current trading price. Now, for the third valuation model, I want to compare Procter Gamble to 3 of its competitors. So I will take these competitors' current stock prices and divide by their earnings per share to get their PE ratios, which I will average out and multiply by the earnings per share of Procter Gamble to get an intrinsic value of $119.48, which is again lower than the current trading price. Now, for the fourth and final valuation, we want to compare the company to its dividend growth. So plugging in the dividends over the past 5 years, we will calculate an average growth rate of about 6%. Now, into the future, I will project a slightly lower growth rate of 5.67%, as I do want to be a little conservative, and get an intrinsic value of $187.16, which is higher than the current trading price. And finally, when we average out the 4 valuation models, we will get an ultimate intrinsic value of $135, which is about 15.5% lower than the current trading price. And with a margin of safety of 15%, we would get an acceptable buy price at $114.75. So overall, PG is looking quite overvalued. They don't have high growth, but they do have very low volatility. So if you invest at the right time or on a recurring basis with its dividend growth, PG might turn out as a great investment. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.